know from looking at the news headlines from one day to the next how frequently the plot twists with unexpected outcomes. Instead of trying to predict complex outcomes with certainty, we're better served by examining the evidence and determining probabilities. This week, with the Dow and the S&P reaching new highs, people are asking if a top is forming. In this week's video, we'll compare the current market conditions to previous market tops to answer the question. First, we'll look at a summary of this week's economic data and interpretation. This week's economic data continue to show record economic strength. Housing continues to be a soft spot, with rising rates, costs, price, and inventory weighing on activity. The most important readouts were on the labor market and leading economic indicators. Claims data continues to drop to levels not seen since the late 60s and early 70s, indicating strong labor demand and an expanding economy. This is supported by the leading economic indicators, which were released for August, and show strong business activity. When the leading economic indicators for each month are released, we create several charts and graphs and post them on our Twitter account, which is shown in the lower left-hand corner. If you don't have a Twitter account, you can still Google @CaliberCap and find our posts in the search results. Now we'll look at our week in review, where we take a look at the headlines and how they moved the market. On Monday, President Trump was to make a new tariff announcement after the market closed. Clearly, this weighed on the market. On Tuesday, the market reversed after the announced tariffs were at a lower rate than what the market was pricing in. On Wednesday, the market continued to post gains and approached previous highs. On Thursday, the S&P and the Dow both put in new highs. On Friday, the S&P fell on 10-year Treasury yields above 3%, a slight rebound in the dollar, and trade concerns, while the Dow notched another record close. The market closed up 0.44% for the week, and the month and year-to-date statistics are provided at lower right. With the markets at new highs, it's natural to begin wondering if we've reached a peak. What can the past tell us about what peaks look like? To answer this question, we need to step back and look at the big picture. This chart looks complicated, but it's not. We'll walk through it step by step. The center panel is a monthly chart of the S&P going back to 1999. We have our monthly candlesticks and two moving averages, the 6-month moving average shown in blue and the 18-month moving average shown in red. So what do tops look like? Price begins to slow moving into a top and then rolls over. We see big tops here in 2000 and here in 2008, and smaller tops in 2011 and 2015. You can see these. You can see how price slowed into the tops and how they have a rounded shape. What else can you see? Notice that the 6-month moving average begins to flatten and turn down as the top forms. With the top in place, the 6-month average crosses below the 18-month moving average. Look here at the upper right. The 6 and the 18 are both positive, with space between them, and price is making a new high. You can see that this does not look anything like the previous tops. But let's wring everything we can out of this chart. The top panel is the Relative Strength Index, or RSI, which is a momentum indicator. A lot of people have been talking about this peak in RSI. When the next peak is lower and price is higher, it's called a bearish divergence. Does this mean the top is in? Divergences can last for years before the peak. Here we have a multi-year divergence that went back to 1996. We have a single-year divergence leading into 2007, and we get another single-year divergence before the 2015 top. There's a reason we look for agreement among multiple indicators for a consistent message. Notice there wasn't a divergence prior to the top in 2011. Now let's move to the bottom pane and look at the percentage price oscillator, or PPO. Remember we talk about white space between the moving averages? Well, this is a momentum indicator that measures the distance between two moving averages as a percentage. What's important is, can we use this to tell if we're in a bull or bear market? Let's work from left to right. Let's say that when the indicator is above this center line shown in red, we're in a bull market, and when it's below, we're in a bear market. And we'll see how it lines up with tops and bottoms. Here, PPO is above the center line, and we have a bull market. At our top, PPO falls below the center line, and we have a bear market. In 2003, the market bottoms, and another bull market begins. And the pattern repeats and repeats. We get a few false signals or whipsaws shown in the orange area. And again, this is why we use the balance of the evidence from multiple indicators. And we continue on with the pattern repeating. And we can clearly see that we're in a bull market and PPO is above the center line. Now we'll look at the ratio of the S&P to Wall Street's fear gauge, the VIX. The VIX spikes dramatically when the market falls. When the ratio of the S&P to the VIX goes up, the market is going up. And when the ratio falls, the market is going down. Can we use this ratio to tell us about whether or not we're at a top? Here you can see the same kind of rounding at all the tops that we reviewed in the previous slide. Since the VIX spikes dramatically when the market falls, we get deep troughs in the ratio, and then you see the market recovers. You can see the start of bull markets at all of these troughs. You can also see that we have a blue line on this chart that is the 12-month exponential moving average. When the moving average is up, the long-term trend of the market is up. Now look at the upper right of the chart, and you'll see that the blue line is rising from a trough, and price, or the ratio, is above the moving average. The market is trending up. Now look at the green circles down at the bottom of the chart. This is something that we tweeted earlier this week, and it's something that I haven't seen since last year. The MACD momentum indicator has a bullish cross, and the histogram below it has turned up above the center line. The pattern at the upper right of the chart does not look anything like the tops that have preceded it. We review the charts for similarity to patterns that have been useful in the past for identifying tops, and here we see little similarity. This doesn't mean there won't be normal volatility that seems frightening at the time but is part of a healthy market. Look at every significant market bottom, and you'll notice that usually the initial rise out of the trough is fairly smooth, but once the ratio is above the moving average again, there's usually a lot more up and down moves or volatility. In the early to middle stages of a bull market, these dips are not something to be afraid of. They create buying opportunities. You should always have a shopping list ready. On it will be items that you need, and you'll know where areas of support are that represent a good sales price with a favorable risk-reward. Now we'll look at a daily chart of the S&P. We've often talked about the markets climbing a wall of worry. Worry is an essential part of ensuring we don't get a euphoric move that runs out of steam and turns into a top. The market has climbed a series of steps out of the correction that began earlier this year. The market reaches a local peak and then drops back down on worry to find support. And then it makes a new high by reaching another peak. Each area around a previous peak can become an area of support, like a step. Then we repeat the process with another local peak, fade to reach a new peak, and so on and so on. Now that we're above the January peak, we're making new highs, and will likely continue in stepwise fashion, but with increasing volatility. Which is why it's so important to step back and see that we're in a bull market, and the long-term trend is still up. Sometimes I leave you with a longer passage that's more valuable than a quote. In a moment, you can pause the video, and as you read this passage, you'll find the essence of the message we present in these videos. The market reflects the long-term outlook of millions of people. This long-term outlook creates momentum, and momentum tends to persist. Momentum creates long-term trends, and long-term trends persist over time, despite the news or particular concerns of the day. To profit from these trends, we must constantly focus our attention on the strength of the trend and be on watch for the tendency of human beings acting in groups to overshoot at tops and undershoot at bottoms. A disciplined model for measuring these things can improve your investment outcomes. Thank you for watching, and I hope you find these videos valuable in thinking about how your investments should be managed. Think about the time it takes to research, write, and put these videos together each week. If you've enjoyed watching this video, please share that enjoyment with a friend. That's what makes continued production of these videos possible. The information in this video cannot address the specific investment objectives, financial situation, or particular needs of any viewer. The information presented is solely for informational purposes and is not a solicitation or offer to buy or sell any security or financial instrument. None of the information in this video should be taken as investment advice. Any opinions expressed in this video are subject to change without notice. Caliber Capital Management, LLC, or KCM, is not under any obligation to update or keep the information contained in this video current. KCM, its officers, employees, or clients may have an interest in the securities, related securities, or derivatives of the securities referred to in this video. KCM accepts no liability whatsoever from any loss or damage of any kind arising out of the use of all or any part of this material. KCM recommends that you consult with a licensed and qualified professional before undertaking any investment decision.